Investors, for the first few weeks of 2026, our team discussed market volatility in our videos, both realized actual volatility seen in the markets, which was low, and implied volatility as expected by the options market, which, starting in mid-February-ish, looked higher. We talked about our thoughts on what might be a very sloppy, choppy first quarter with a pullback possible between February and mid-April. For the second half of 2025, in our videos and at our Oak Harvest educational events, our team messaged what we saw is inflation dropping faster than others expected. Our rationale back then was focused on a few things. First, housing costs, or shelter costs as economists refer to them, which our data said were slowing faster than the government data reflected in their numbers. Here's Goldman Sachs' chart and their forecast on shelter inflation. Given the weakening job market and its forward effect on people moving after changing jobs, and given the tighter immigration policies over the last 2 years, Goldman Sachs expects shelter inflation to continue lower to 2.25% throughout 2026, below the 3% shelter costs that prior PCE measures came in at. Of course, that's a good thing on the good-bad scale of inflation. The other two parts of inflation equation are goods and services, each which rose substantially after the reopening of the economy, post-COVID, 2020 fiscal and monetary stimulus programs. We all remember 2022 and the 7 to 9% inflation prints during the year, don't we? Here's Goldman's charts on core goods and service inflation, and it's easy to see the Matterhorn-like inflation ramp in 2021, 2022, and it's slowed down ever since. Investors, on the service side, wage inflation continues to slow as a combination of weakening job market, layoffs in white-collar jobs due to AI, and productivity gains of AI are helping keep service costs down. That's good news on the good-bad scale of inflation, which leaves only the good side of inflation, which according to Goldman Sachs is slated to actually accelerate some here in the first half of 2026 on the back of tariff pass-throughs on new inventory purchases and higher commodity input costs. So Chris, inflation was coming down in 2025 like your team expected last year. Why are you dedicating an entire episode now when most seem to have moved on to other topics like geopolitics, Fed rate cuts, and things like AI? Well, investors, because our team gets paid to worry about things and risks others aren't, trying to anticipate what fears linger around the corner before others do. And right now, the real-time market data in the bond market is flashing a severe yellow warning sign to me for an excuse for a first quarter sell-off. A sell-off that, if it should happen, one that our team thinks would be one of the few buying opportunities of the year, but nonetheless, down is down. Investors, here's the imputed one-year break-even inflation rate as seen by the Treasury bond market. Yes, I know 1 year is likely to be a very short period for investing standpoint, but we're looking for market-based signs that might actually lead shorter-term investment downturns and upturns to help make tactical moves and optimize one's investment portfolio if one so desires. As we've discussed in the past, inflation in the U.S. is seasonal. This seasonality happens a lot as we're a service economy and wages and benefits change in the new year, like Social Security, cost of living adjustment payment increases hitting in the new year, and medical cost bumps in the new year as well. I mean, has anyone looked at their medical insurance renewal costs here in 2026? If you haven't, sticker shock is coming. You can see the seasonal turns up in January and early April on the previous chart. The reshoring of manufacturing goods here in the United States, while needed from a standpoint of independence, is inflationary. The exportation and deportation of low-cost, lower-end labor source, while a policy many agree with, is inflationary. Weaker dollar as investment capital moves offshore to their homelands, which the administration seems to be okay with, is, yes, bad for higher inflation. So if you ask me what keeps me up at night over the next 3 months, I have a simple answer. The stock market sniffs out late, as it does most of the time, a seasonal impulse, higher inflation, causing a February, call it a tax day sell-off. Should this happen, does our team see it as the end of the bull market? No, that would be doubtful given how earnings are likely to progress and likely a new dovish Fed chairman is in May. Investors, 2026 has started off fast and furious in a negative way with higher volatility. This was a risk our investment team had entering 2026, why our first video of the year was titled Patience after the Guns N' Roses rock ballad. The first half of 2026 is one of those years that the options market is hinting at a real buy the dip moment coming later in the first quarter. The good news is that our investment team has experience in these types of markets. Remember, investors, that elevated volatility also means elevated opportunity for longer-term investors. Historically, Investors' biggest incremental returns come from investing when volatility is high, not low, and markets are down, and others are either acting emotionally, or worse yet, being forced to sell when they really should be pushing their chips into the center of the table and adding to their investments. So what does all this mean to you? Our advice to you is keep following our investment content on Oak Harvest website and our YouTube channels. We addressed our 2026 market outlooks last night on YouTube with Troy, Charles, and myself. Investors, whether you desire growth or income or a combination of both in your portfolio, the entire Oak Harvest team is here for our clients, doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.